Good afternoon and good morning for some of you. Welcome to our Women Get On Board Speaker Series. I'm Deborah Rosati, founder and CEO of Women Get On Board, and I want to begin our Women Get On Board Speaker Series today by acknowledging the land in which I live in the traditional territory of the Anishinaabe and the Haudenosaunee. The Upper Canada treaties cover this territory, is within the lands protected by the Dish with One Spoon, the Waupun Agreement, and directly adjacent to the Haldimand Treaty Territory. Today, this area is home to many Indigenous people, and we are grateful to have the opportunity to enjoy the natural surroundings of this territory. I encourage all of us to become actively involved in understanding why land acknowledgements are important and understanding Indigenous histories and contemporary Indigenous issues in Canada. Thank you. Women Get On Board is delighted to be hosting this virtual speaker series today. Women Get On Board, we have a mission to elevate the next generation of women corporate directors. We have 950 members across Canada, and we believe in the power of three. One woman on a board is token, two women on a board is presence, and three women on a board is a voice. Which brings us to today's topic, because we need to have the knowledge and the courage and confidence to serve on boards. So we are delighted to have sponsors, our sponsor today, Southleigh Group. They are a trusted advisor firm that works closely with boards and senior management with their expertise developing innovative and customized people and pay programs that will enhance business results, and the breadth of their experiences brings together business strategy, financial analysis, human resources management, board governance, communication, disclosure, and investor engagement. Our topic today is executive compensation trends and predictions for 2024. We are excited to have Amanda Fogley, President and Managing Partner at Southleigh Group, along with her colleague, Alex Botello, partner at Southleigh Group. Today, they will discuss Southleigh's research on the latest trends amongst the S&P TSX 60 companies across Canada. This session will explore the findings in terms of compensation levels, incentive design, and other governance features. Amanda, over to you. Welcome.
Thank you, Deborah. We're so happy that everyone is here today. I'm glad you could join us. And we also appreciate the strong relationship that we have, Southleigh Group has with Women Get On Board. So we're going to keep going strong. So if we go to the title slide. Well, actually, before we get into this, what I wanted to say is just in terms of the format today, there are 10 slides here that do cover what Deborah said, the S&P TSX 60 analysis that you all want to hear about, and that's great. However, we also have a slide at the end where we wanted to make sure you got some of the insights, because Southleigh Group was set up as an organization that not only provides data, but provides insights and perspective. And so we wanted to share with you the top 5 predictions that Southleigh Group came up with at the beginning of 2024. And I know we're only halfway through, but Alex and I thought it would be fun to share those with you in the case you hadn't seen them on our website, and just sort of have a conversation about it, because I think that that's potentially more useful to you in your day-to-day roles versus some of this market data that's already a little bit dated. With that, I will jump in. And also, Keisha is taking questions. So please feel free to put your questions in the chat. We're reserving 15 minutes at the end for that discussion. And we look forward to the dialogue. So is CEO pay in Canada a runaway train? This slide would suggest not so much, which I guess is good news in terms of the fact that you can see here CEO pay from 2021 to 2023 in the middle row there went from 10 million to 10 million. So we don't have the Elon Musks of the world sort of putting pressure on overall pay for CEOs. And you can see also for the other NEOs that the trending has been pretty flat. We like to put, this is actual salary, actual bonus, and actual long-term incentive awards added up. So we do want to also reflect on performance. So what's also interesting about the change from 2022 to 2023 is that revenues did go up, on median was only about 4%, and TSR did go up about 9% between 22 and 23. That didn't, on average or at median, have a significant impact, obviously, on the total compensation levels that are paid and are displayed here. You also can see that the most notable change, in particular for the CEO, would be the LTIP component. So I guess we're not surprised by that. I do think that, again, as pay changes, we would expect it to be in the long-term incentive component versus the short-term incentive component, again, over time. On the next slide, we have an interesting analysis of what's happened with respect to the multipliers. So the actual multiple as a percentage of the short-term incentive target. And what jumps out at you here is the green, of course. So the green is 2021. That was just post 2020, which we all know was COVID, and businesses really did struggle. Many businesses had a hard time in 2020. So the question here is that why? Why does 58%, if you add the two bars on the right-hand side of the slide, 58% in 2021 of companies in the S&P/TSX 60 had paid multiples higher than target, 58%. That's a very high proportion of the distribution, as you can see. More recently, the orange bars in 2023 paid approximately 33% above 1x. So that obviously is more of a normal distribution. And we do think that that normal distribution is more where we're settling back in. When we reflect on what is learned here, we can share with you that through our work all of these years, that post-COVID, a lot of lessons were learned around target setting. So in terms of doing more shock testing on financial and operating measures than had ever been done before, obviously because due to COVID, things happened that had never, ever been contemplated. And that just had not been incorporated into the incentive plans. On the next slide, Alex is going to talk a little bit about forecasting the future.
Yeah, thanks, Amanda. Hi, everybody. So as we all know, when we're looking at public disclosure, it's often in the rearview mirror. We're behind a year. So we were trying to reflect on what do we anticipate for 2024. One of the influences on 2024 budget setting is voluntary turnover. So as we all experience, probably have bruises from the conversations that it was a tough talent market in 2023. High inflation, interest rates were rising, still strong demand, and we saw that in talent markets, certainly for the executive group. And so you can see in February 2023, voluntary turnover at median was around 11% or even higher at the 75th percentile. And this was felt in certain industries. It started to come down over time. So then compared to our most recent study in 2024, this February, the median's down to 8%, which is more normal of what we would have seen historically. There's still a wide range between the 25th and 50th, but the median has started to come down. And I think you may all agree, maybe nodding heads on behind the scenes, that you're starting to feel a bit of softening in terms of the indicators or influences on voluntary turnover. That is likely to lend itself to softening salary budgets. So when we think about historical norms through the past decade, salary budgets were more typically in the range of 2 to 3%. Over the last couple years, the range has become more like 3 to 4%. So if we're trying to use these indicators and forecast what we expect for 2025, I think our crystal ball would suggest they're going to come down a little bit more. And certainly where the budgets are created, it's more likely to be used for targeted groups. So rather than applying a 3% across the board, it would be a 3% budget, but very specific to certain talent groups. So on the next slide, Keisha. So here we're getting more into incentive design, moving away from levels into the design and framework of incentive plans. So first looking at the short-term incentive plan, I know there's a lot on the page, and I think the key takeaway, which is consistent with the pay levels, is that we're not seeing a lot of year-over-year change in the incentive designs, and that's probably expected. When you think about short-term plans, these programs are set up to be enduring and to allow for a consistent framework to be used year over year. So in terms of the number of measures, we're still seeing this idea of a scorecard design. Businesses are complicated, and therefore the scorecards require certain measures to reflect that complexity: financial, operational, um, health and safety, individual performance. So that's why there's so many measures in the plan itself. In terms of the prevalence and weight, we're still seeing high weight on financial measures. That's critical indicators of executing your business strategy. It also ensures that there's affordability in the plan. The interesting piece on when you layer in some of the environmental, social, and governance components, that's where you start to get into higher weights on these non-financial measures, which have become more common over the last couple of years. In the next slide, we get into the long-term incentive design, and Amanda's going to give an overview.
So you're asking what's changed in long-term incentives, and this chart is suggesting not very much. Alex and I were pausing on this slide because it is the data, but it's not really telling you any story or the story that we hear around the conversations at the boardroom level. So we would say that there is continued pressure, as you probably know, on the use of stock options. I mean, I'm not sure Alex and I know why exactly, because the use of stock options has dropped so much. You can see on the mix of the portfolio in the median of the LTIP mix of LTIPs in large Canadian companies. What this is showing you is they're as low as 20% weight on stock options. So they've already been moderated down in their use to a pretty small proportion. And there is a good use for stock options. That said, for the organizations, and there are a few within the six, you can see that's why it doesn't even show. It's very confusing because what happened is I'd say a handful of Canadian companies have swapped out stock options for 3-year performance share unit plans, and in some cases, 3-year restricted share unit plans. And we're going to get into a little bit of what the consequence of that is, and that we do think that there's an alternative in a couple of slides. But that's the point, is that, despite the fact that it looks like everyone has the same number of vehicles and they have a similar mix with, of course, dominated the middle big block in the middle right, 50 to 60% weight on performance share units. So that means at the end of 3 years, we lever the value up or down based on some kind of metric. Dominant weight and low use of stock options. However, still many conversations around, is this the right mix for our business?
Yeah, just adding to that, Amanda, I think this reflects what we're seeing with organizations, that they've gone through the last few years with a lot of pressure on stock options, and these companies have decided, no, there is a place for stock options. Then it reflects the idea of moderation. So coming up with the right mix or right weight of options within the portfolio. So the companies have already agreed there's a place, but the relative weight is smaller, and it's often balanced by the RSU. So if the RSUs are more the midterm plan, then the options offer that longer term component.
Yeah, thanks for that. That's right. So on the next slide, we talk about within the performance share unit plan, it's very difficult to know that you have the exact right measure always in this. So we spend an inordinate amount of time trying to make sure that we have the right measure aligned with the strategy, reflective of the market, all of those above considerations. So, and there continues to be pressure from institutional investors to have more than one measure. That's what's sort of reflecting on the left-hand side here. It's been a long noted observation from some of the institutional investors that you should have more than one metric in your incentive plan. It's also been long noted that you should have some form of relative assessment in your performance share unit plan. So those two things jump out at us, right? 31% of companies continue to only have one measure, but look at how many others have diversified what they're measuring within their long-term incentive plan. 31% has the 2 measures, and then you can see 23 and 15 with 3 and 4 measures in their performance share unit plan. So in those cases, they're customized metrics based on the fundamental financials or key performance indicators in each of their organizations. On the right-hand side, we're going to talk about ESG. You might, say, where's ESG on that chart on the right? We're going to have a chart on ESG, a couple pages on ESG specifically. It is technically in that non-financial component there. But you can see the variety of measures that are tacked into the performance share unit in addition to relative TSR. So on the next page here, this is the Southly answer to, if you are concerned about the use of stock options, we do think there are other more innovative solutions to just picking the standard 3-year PSU or RSU replacement vehicle. And the conversation that's being had is around, is 3 years long enough? That, of course, was the benefit of having a stock option, that we could go beyond 3 years. And many people were experiencing 5 and 7 or even 10-year horizons on their stock options. So what this plan is demonstrating is, imagine, if you will, a treasury settled, an equity settled restricted share unit, we'll call for now, that can go invest beyond year 3. And some people on the line might not understand that you can go beyond 3 years. The trick is that it does need to be settled out of treasury or a fund, employee benefit trust. But let's focus on, so the old stock option pools that are already approved in many large organizations that are either less utilized or not utilized. What we're trying to say here is, let's reconfigure the use of that equity reserve. And the benefit of doing that is, as you can see on the page here, it gets the horizon longer. You can also put a PSU type mechanism on the end, as we're illustrating here, at the end of year 3 or 4 or 5, if you want to vest over those years, rather than waiting all the way, say, till the end of year 5. And the magic of this plan is that if you used absolute TSR, which is what we've got in the example here, so if you don't increase share price, because we've got it at threshold at 0, and if you have less than 0% return over the, say, 5-year period, it actually would vest to you as 0, just like a stock option. However, if you had a 20% absolute total shareholder return in this example, we're going to give you 2 times as many units. So you can imagine the doubling up of the share price actually going up 20%, and then you're getting 2 times the number. It starts to look a little bit more like a stock option on the top end there. And this is also a really great vehicle for organizations with a high yield, high dividend return, because the former stock option plans were not giving the executives the benefit of the yield or the dividend or distribution over time. And so that was frustrating for them, because that was value they were creating that they weren't getting recognized for. And in this case, if you're high yield and want to go long term, it allows the executive to benefit, because these are notional shares, full shares, rather than an option. So we think it's quite an interesting, exciting tool that some organizations are considering as an alternative to stock options.
So we'll speak a little bit about the prevalence of ESG measures in incentive plans. And I appreciate this is a bit of an eye chart to fit all of the information on one page. There is that blue box around the US and Canada, but we're also showcasing the trend of prevalence of ESG measures in incentive plans, short-term or PSUs, across different regions around the world. So it's great to see in Canada and the US that we're starting to reach 75 or 80% prevalence. So it demonstrates the view that these measures are important to the business strategy. And it's also great to see the trending. So you can see from 2020 up to 2023, there's been significant growth in Canada and the US. It's also interesting to see that we are still chasing some regions outside of North America, upwards of 90% prevalence. And the measures that these represent, social measures still continue to be the most common, but we are seeing a trend towards the environmental measures, certainly carbon reduction or any project that support clean energy.
And I'll just pause on this. The other reason why the other countries are winning in this game of figuring out ESG and how it links to incentives in terms of, it's 90% plus in these other regions. And as Alex said, we're down at the 75 or 80, although I think that's very, very good. It's just that we are one of the biggest carbon emitting countries, and we don't have it at 100 or high enough. And so what I would say is we just had a breakfast session with our global leaders through our network, the Global Executive Compensation Network, and something that they reiterated, which I think is important, is remember that in many of these other countries like Europe, the UK, and Australia in particular, they have to have 100% PSUs. So there's even more have to, I mean, they don't all, but there's a lot of pressure to have 100% weight on a performance share unit. So they have maybe more dollars at play that they can put in some more measures, as well as different, I'd say political environments where they're being pressured a little bit more than we are in Canada.
Yeah, that's good context. So on the next slide, we thought it would be helpful to showcase how these ESG measures are included into incentive plans. And when we look across some of the Canadian companies, we pulled these examples because they do represent the spectrum of different frameworks that are used. So working across the country, if we look at TC Energy, an energy infrastructure company, they reflect what you would typically see in terms of having measures within a corporate scorecard. In this case, they're very clearly disclosed measures and targets. The evaluation is quantitative, and then they put 30% weight. So that would be a more typical design within the short-term plan. One of the trending topics is you could include ESG measures within a modifier. So WSP, an engineering consulting firm, they disclose and present this to investors as a strategic performance modifier. So it's not necessarily referenced as ESG, but when you dig into the details, the majority weight is on ESG priorities, as well as some technology projects. And the influence that that modifier can have is 90 to 110% of the corporate STIP score. Barrick, you may be familiar with this design. They look at a robust scorecard to set the grant value. So the value of the LTIP grant can go up or down in a given year, and it's influenced by a pretty robust scorecard. Within that scorecard, they have a sustainability section. It's weighted 20%, and it's pretty robust. It has 5 categories, 28 metrics. So we're not necessarily suggesting companies follow that route, but it is a helpful reference if you're looking for what a type of scorecard can be that covers that broad terrain of sustainability metrics. And then Fortis, what's cool about Fortis is that they include ESG metrics both within their short-term plan and their PSU plan. And then they break up the different measures depending on what is important over a 1-year period versus a 3-year period. So the time horizon matters in terms of making progress on certain priorities. And further, they included a modifier within their 23 PSUs. So it was a feature that was added to a single grant cycle, 23 to 25, but it's not necessarily included in every PSU design. So again, it gives some flexibility to evolve the ESG measures over time. When we think about governance, say on pay obviously immediately comes to mind. I won't spend a lot of time on this slide, but it is interesting to note that the Global Mail board games, as they tried to differentiate some of the scoring, they proactively flagged some of the changes that are about to come up in their evaluation for 24. And one of them is they're saying now they're going to give maximum points if companies have a say on pay score greater than 95%. Previously, it was greater than 90%. So they've raised the bar. And when we recalibrate and show the say on pay results into the different buckets, Canadian companies, 50%, so the majority of companies in so far in 24, have received more than 95%. So you could say Canadian investors are friendly markers compared to the US companies where it's only 20% that are getting that over 95% support. And if you sort of question, why is that? Well, it could be that Canadian companies, if you think about it, our pay levels are generally a little bit lower than the US. We do really have strong disclosure and genuinely have an interest in providing transparent information to investors. And then we also relatively have less activism in Canada. I know that might not feel that way lately with some of the headlines, but we generally tend to have pretty good engagement with our investors. On the next slide. So when we think about the influences on executive pay governance, there's a few different topics. I know this is starting to take, there's some of the topics we're going to talk about in our fireside chat, so I won't cover all the items on this page, but the couple that stand out, Glass Lewis was pretty active this year in announcing some changes to how they evaluate different programs. The one that was call it interesting or most radical is how they're viewing clawback policies. So we're all familiar with companies having a policy that if there's a financial restatement, the board can recover compensation paid. Well, Glass Lewis is saying, let's give the board flexibility to use that clawback in a broader set of events. So it doesn't have to require a financial restatement. It could be that there's executive misconduct, or they even go on to say, what if there's material reputational harm, or they use material organizational failure. So we could have a whole podcast on trying to guess what they mean by all those words. But the point is that they're suggesting these clawback policies should be expanded to allow for a broader set of circumstances. And in the event that Glass Lewis deems an event occurs and you don't have that flexibility and you don't express how the board used some discretion to align pay and performance, then they could vote against say on pay. So I know there's a lot in there and happy to discuss further, but this is a topic that we're monitoring closely. The
And
other
maybe
one, yeah.
I'll just add to that one a conversation that I recently had with a CFO of a publicly traded company about this, because it's many people's initial response to this clawback policy change is that it's overreaching and that it's very hard to interpret, and do we really need it? And I think the US, where more of this comes from, they actually might need it if you look at some of the cases that you've seen. But also this CFO actually has said a very wise thing in terms of, why not? Because if you don't want something like this, then what are people hiding? And also it allows support for a culture of complete transparency in the fact that CFOs and CEOs do make decisions on all kinds of assumptions in accounting and other things that will eke it a little bit more on the side of good in terms of culture and good decision making. So I thought it was interesting that a CFO of a publicly traded company actually was like, don't tell anyone I said this, but
just within our within the confines of this webcast.
Exactly.
On the Globe and Mail, so I spoke about the raising the bar on maximum say on pay score. The other one that's interesting is that they're raising the bar on maximum points for dilution. So previously you would have maximum points if your dilution or overhang was 8%. Now they're lowering it to 5%. So generally this aligns with the investor sentiment that they want to moderate dilution. It's a bit of a head scratcher because that seems to be counterintuitive to what Glass Lewis, proxy advisors, Global Mail is saying around share ownership, because the only way that we can increase real share ownership is to actually issue more shares, which requires dilution. So if you really sort of dig into it, I think this is a bit of a subtle play on reducing weight on stock options, because those tended to be the vehicle that created the most dilution.
Yes, and we would think it's a little bit short-sighted, unfortunately, which again will dovetail into that third bullet on increasing real shares into executive hands. So we'll get into that a bit more in our chat. But it does 5 to 8% dilution truly matter to the shareholder is a question we would ask. So here we are, 5 predictions for 2024. We developed these, as I said, for January, and I'm going to just tell you what they are, and then we're going to take the slide down just so it's more of a chat. And again, we welcome questions as we go through this. So evolution of share ownership policies, I just alluded to it. The Canadian Coalition for Good Governance issued a paper in 2023 that led us to believe this was going to be a hot topic. Reconciliation of adjusted measures was put on the list because we had noticed that there was way more attention being paid in the ISS and Glass Lewis reports coming back to public issuers on do better as it relates to if you use non-GAAP measures, explain and detail. Quantification of ESG measures. We talked about the trending of those measures. It's been a long conversation. Climate, say on climate, other actions like that have come up. And so we anticipate and are continuing to anticipate that we're going to get better at measuring ESG. It's been a few years now. Pressures on directors' pay is on the list because it's been a while. COVID and the years following, directors didn't really want to talk about their own pay. So we knew and we experienced, based on the number of directors' pay analyses we were asked to do in the last little while, that there was going to be focus on directors' pay. And finally, pay versus performance evaluation was on the list, mainly because in the US, a new required disclosure rule with very rigorous standards and directives was issued for US issuers. And we wondered what the consequence in Canada would be. So we'll just dive into the conversation. So you thought you knew everything about share ownership guidelines, right? Pretty boring topic. That is true and was true for all of you, I'm sure, until CCGG, Canadian Coalition for Good Governance, issued a paper in 2023 that threw everything that you know into a jar, mixed it around, and threw it out in a different format. So some of the key things that you need to understand about that message is that they did an analysis. This isn't coming from nowhere. They did an analysis of Canadian public companies, and they looked at how many real shares the CEOs had relative to how much they were being paid and how long they've been in their roles. And they were woefully disappointed. Like, there's facts. It's in the front of this report. And maybe none of your organizations can be accused of this, but there's a whole body of people that don't have real shares. So they issued new guidelines. And what the guidelines say that's important you kind of understand at a high level is, we always talk about multiple of salary. Well, there isn't a lot of reason for why it's a multiple of salary. What they're asking for now is for you to define it as a multiple of total compensation. Then the multiple is lower. So if you had 5 times salary, it's 1 times total compensation or something like that. So it's not trying to increase the dollar figure. What it's trying to say, which is not wrong, is that when you look at a CEO's pay package, the majority of their compensation is in the other vehicles. It's in the short-term plan, it's in the long-term plan. If everything's a function of the little salary that only moves at 3% a year, you're missing the story and the progression of the CEO's pay over time. They also want real shares. They're sort of done with this notion of phantom counting as real. And in Canada, that's a problem because I'd say 90% of the restricted share units and performance share units are designed to settle in cash. So they, in this new world, in this new version, wouldn't count towards real ownership. They do say real shares, and there's an asterisk because they do include deferred share units. So that's interesting, and we'll talk about what the consequences of that might be. And finally, importantly, they've lifted the requirement of the time horizon, which really helps in our view, because then it's just figure it out. Can we agree with the philosophy that an executive who is a steward of the organization is responsible to use some of their compensation to invest in the organization over time? So, Alex.
Yeah.
What are the consequences of this? Did we win? Is this a hot topic?
Definitely a hot topic. If I think about the conversations we've had with organizations around this, a lot of it is education. So understanding the move from to what you have to how would a company transition? And it really is a radical change. It's not taking your current 5 times multiple and now saying it's 5 times total compensation. That would be crazy. So it does require a full shift, that you're going from a big multiple to a small multiple, because the denominator is very different. It's also recognizing that it's a more restricted set of vehicles that are counted in the calculation. And then to your point, the key one is, this isn't now keeping your typical 5-year compliance period. It is just saying, we want to make progress towards real share ownership over time, full stop. And that might end up meaning that we're not achieving these requirements until year 10, or it's aligned to an executive's tenure. So it is a paradigm shift. And I think that the key here is that we would all agree the current share ownership guidelines and your current long-term incentive plans create alignment to shareholders. But CCGG is saying what we're asking for is ownership, not alignment.
Yeah, and I would offer that we're seeing interest in two things, just to keep in your back pocket. And it's not even necessarily because of this one specific thing. I feel like these are ideas that have been around for a while, but this paper is going to push us more towards them. So number one is reconfiguring that option pool plan to be an omnibus equity plan, so that you can settle your vehicles in real shares. Like right now, we don't have the dual. Let's get the dual. It's not really a big issue. I do think that's a more simple approach for those of you who can do that. And the second one would be potentially the use of deferred share units in the long-term incentive plan. That is more foreign to Canadian issuers, but having a portion settle in a very small portion, maybe settle in deferred share units over time, could be part of the solution.
Yeah, I agree. I think there's companies that when they run the analysis, you might be surprised to see it already achieve this. So it's an easier transition. And then the concern is, well, how would a new executive achieve this over time? And therefore they need the tools that you're describing. There are, I guess, a few industries where there might be some caution around this. So if you were to say, well, just include more weight on DSUs, well, DSUs have a bit of risk if you're a commodity cyclical company, and that really influences the timing of when someone may decide to leave and access value, or there's a very short window of time when you can realize compensation from DSUs. And if that occurs during a commodity downturn, then there's concerns there. So it's not without risk, but I do think from a philosophical perspective, having executives own real shares is hard to argue with.
And just a final note on that also, well, two little notes. One is companies are doing this. We have clients that are going to do this change. And part of the reason, it's certainly not the only reason, but part of the reason is, as Alex said, they're already there. The executives own it. And they're going to get maximum points under the board game. So this is, again, another thing that the board games jumped on ship and changed their definition of ownership and to align with this, which, so a bunch of companies, if you cared, and I know we don't design things to appease the board games, but you got to, with your head up, realize that if you don't make the change, you're going to lose a couple points. And the second point was, share purchase plans. We also think there might be an interest in unburying the share purchase plan. Many Canadian companies have one. They all look the same. Is there a way that even the CEO could use that plan to effectively, efficiently buy shares and not, draw attention to the fact they're doing that? So definitely a lot of consequences to consider due to this paper. If you haven't seen it, CCGG website, it has the full thing there. Moving on. The next topic is about transparency. So as I alluded to, the point of having really good articulation in your public disclosure, because I know you have good reasons for doing what you're doing on adjusting any financial or operating measure that doesn't align with a GAAP measure. You have the reasons. This is just pointing out that in your disclosure, you should do a good job of explaining your rationale. What are the adjustments? Like, no one wants to see as a shareholder that your earnings were at this level, but people are getting paid even better based on some other earnings number that looks higher. They just want to understand why you're making those adjustments and the rationale for that.
Yeah, just adding to that, if you think about a company that reports on earnings per share in their annual report, and then they also state adjusted earnings per share in their annual incentives. Then the use of adjustments can be quite reasonable when you think about currency exchange or big changes in commodity prices or unplanned events. So the use of an adjusted measure, we can understand rationale. Investors just want to be able to reconcile with when you use an adjusted measure, how can I compare that back to what you shared with me in the annual report? And it's surprising to see the number of organizations that don't give that sort of reconciliation or even just reference back to the annual report how these numbers differ.
On the third topic, ESG has been pretty commonplace for quite a few years, probably in conversation and around Canada, around the boardroom tables, around management teams for a long time. And as you saw with the reporting back, it's been in incentive plans, but we do need to do better is the bottom line. We do, now that there's better reporting requirements on ESG, there are clearer strategy documents being issued by these public companies. The point of this is doing a better job of linking those public strategy and pronouncements and promises that are being made to more linearly back to how people are being paid with real numbers and real testing. So we are in our work day in, day out, helping clients, in particular those that are climate impactors, do a better job on doing better quantitative assessments of their progress towards these objectives.
Yeah, on this one, we were talking about this as a team. When you have an ESG measure that's weighted 5%, the use of qualitative measures can be understandable. You're going to use judgment. It's a modest weight. When you start to have weights of 10, 20, 30%, or it's a modifier, that's when I think investors and the board are expecting robust target setting and more quantitative measures. This also represents the walk before you run idea, where in the beginning, ESG measures were included within the short-term plan, part of an individual measure, or maybe again, that 5% weight. Now, as we saw in the examples, it's a meaningful weight in the scorecard, and companies are starting to introduce it in the PSU, where you need 3 years to make progress, or it might not be in every grant cycle. You might cover a 3-year period. It gives you time to make progress, define what your priorities are, and then put it in the next PSU cycle. So it does represent the evolution.
On the fourth prediction, we consider if you were a US director sitting in America, being asked to come and sit on a Canadian board, as we do see more and more these days. We've always had that, but we are seeing the talent market for directors expand. You can just imagine what their expectations for compensation would be. We know that the actual quantum on a nominal basis is higher in the US, and they want it in their home currency, in US dollars. So we are seeing that there is pressure on directors' compensation, and it is going up. We're not have the statistics here. It does depend on your industry and size of organization, et cetera, but it is going up. There are meaningful recommendations being put in now that will be disclosed in a year from now on catching up, because as I said in the preamble, directors did hold off for a number of years as well. So there's this American influence, as well as the fact that there had been a restriction on their own pay, self-imposed for a number of years. There's a bit of catch-up happening right now.
Yeah, the competitive market is certainly a big piece. There's just also the recognition that boards are wrestling with complex topics and decisions, and that reflects a greater workload. So it's the same perhaps quarterly schedule, but the meetings are longer, the materials are more robust. So all of that puts pressure on pay levels, on pay design. There's the idea that should equity be delivered only in, say, a DSU? Is there opportunity for other vehicles that allow for a director to manage their overall portfolio, or again, contributing to real common shares as opposed to DSUs? And then the other topic that comes up is the full board experience. So getting away a little bit from the monetary components and more about learning and development opportunities, participate in strategy sessions, ensuring that there's travel fees if we're asking directors to travel from broader locations to attend a board meeting.
And on the final prediction, we were talking about the pay for performance assessment that is done in Canada. And we were sort of right on this one. Because
Half marks.
half marks. We as Canadians actually have had very good disclosure already. We are good rule followers. We're pretty good communicators. That is not the general experience in the US. When this rule came out, and it's you can look it up, but it's very, very compliance heavy, tons of calculations, tons of math, and they're required. So there's not a lot of flexibility. So they've kind of backed themselves into a corner. Whereas in Canada, we have a lot of flexibility and we do the right thing. There's different ways to show and prove that you've got a good pay for performance alignment. But I will say that we did learn a couple things. So the two things I'll share with you that you could take back and maybe think about in terms of your disclosure is, one is that I like how they thought about stock option values. This is kind of nerdy and detailed, but they value stock options. They value the in the moneyness of stock options, which requires you to redo a Black-Scholes of an in the moneyness. Again, geeky, but that's different because what we do right now is we do the in the money value of a stock option, which is so temporary that you use the December 31st price, and you have to draw a picture of that. Next December 31st is obviously going to look different. So I do like that. And the second thing that they celebrated was that there are multiple definitions of performance. In Canada, we are all a little bit too hung up on relative TSR. And so what this says is like, pick your best measure and show how your pay aligns with your favorite performance indicator. Could be a financial measure or operating measure. So I think those two things are good reminders of the way in which we should think about pay for performance. Deborah.
Well, what a conversation. You have, both you and Alex have so much to share. I could see why, you could continue this conversation for some time. So there are a few questions that were popping up. I did have them on my screen. Let me pull those up again somewhere. Hold on, I did have them. Well, one of the first ones was to do with turnover. And the question was, when you were talking about turnover, were you talking about NEOs? Were you talking about executives? Is when you were using the turnover stat, who are you referring to?
Yeah, it was the broader executive team. So not specific to the named executives, but what companies would define as their executive team.
Okay, wonderful. I think that clarifies. Then there was a question is, can you explain what RSUs are? Just what does that mean?
Sure. So RSU is a restricted share unit. And essentially what it is most often they're calibrated as a phantom share, but it's essentially like giving someone a real share. So it tracks the value. So one of them would track the value of one share over time against the public markets. And usually they vest after 3 years and then are settled at that time. So if you're still employed after 3 years and the share price is up, then you get the full value at up. And if you're there for 3 years and it trends down, you get less value delivered to you.
Good definition. Thank you. So here's another definition. I think there's lots of different acronyms. What is the full name of CCGG paper? And I'm wondering, Alex or Amanda, if we can include it in our follow-up materials.
Absolutely.
But do you want it? What is the full name for that for purposes of this question?
Yeah, so and I just put it in the chat with a link, but the full name is Management Shareholder Alignment, Effective Equity Ownership Policies. And it includes some of the research.
No wonder you couldn't find it.
Yeah.
And we'll put it in the link. We'll put it in the thank you.
It's hidden. Oh, thank you. We have that shared. Okay, and then I'm just going to the other questions. There was one around for SOG, how does CCGG recommendation align with average CEO tenure? And so maybe we'll start with that. And then the follow-on is real ownership realistic for them, given there's no timeline? How do we ensure that they are at the right level based on role? Do you want me to reread that?
No, I can take a first shot. I think that's a bit of the how compliance with this or compliance is tricky, because as Canadians, we want to be rule followers. We want sort of the defined guidelines of when we know we're compliant. and CCGG is more principles based. So what they state is it's just about progress on increasing real share ownership over time, which I know is quite vague, but it does leave open to interpretation by a company to define what is the right level of ownership or what's the right frequency of timing. It was the board games that proactively released how they're going to score these things that put a bit of a stake in the ground to say if a CEO has 5 years tenure, then we would expect the multiple to be 1 times total compensation. If the CEO has 10 years tenure, we would expect we'll give maximum points when you have 2 times total compensation. So it's board games that put a bit more quantitative framework around it, but CCGG would say just make progress over time.
Very principle based.
Yes.
At all times, just progress over time. Another question on the downward trends for executive salary budgets. What would you estimate or guess on the quantum for 2025?
Yeah, I can go first.
Go ahead. Yep.
Yeah, well, I do think the disclaimers, I think it'll vary by industry. And we've seen that in the past. You know, financial services tends to be a little bit lighter than, say, mining or oil and gas, but across the board, across general industry, if the current projections for 24 were 3.8, I think it'll come down maybe more the 3.5 range.
Any predictions from you, Amanda?
Yeah, I'd be similar, I think. I feel like the conversation that's being had at the boardroom, we put that page on purpose with the reduced turnover rates. There is less opportunity than there had been in the past. People are staying put. So if I was at the boardroom table, I would be asking, why is it so high? You know, we just, it bumped up and when will it come back down to the age-old 3%? I don't think it's there yet, but it will probably one day.
And these are not directly correlated, the budgets with inflation, but they do have a sort of directional movement. And so depending on what the Bank of Canada does over the course of this year going into 25, that will also put or influence budgets.
Wonderful. We've got one more question, I think. Okay, question, considering board comp, I heard you speak to US directors and they want to be paid in US dollars along with pressures to keep them competitive. How about Canadian members? Do you see that stabilizing, or do you think we'll have the same comp pressures to increase overall comp values?
Yeah, we think it's going to have an influence on all Canadian boards, regardless if the person is Canadian or American. It is, there's more and more peer groups for directors that are a composite of both the Canadian companies and US companies. And when you aggregate those two sets of data, you have to ask yourself the question of, do we convert them to US? Do we keep them at nominal? But even just by virtue of adding US companies, there's a bit of an uplift. So I think the Canadians are going to rightfully benefit. This is just the market for director talent, and it is just going up because of their influence.
Well, and I also think to Alex's comment earlier is just the pressure and the time commitment that directors have to show up and be there to deliver in very, you know, VUCA times, right? Which is volatility, uncertainty, complexity, and ambiguity. So that's putting a lot of pressure on perhaps increased value for director comp. But I'm not the expert. So I don't believe we have any more questions. So I want to say thank you, Amanda, Alex, for sharing your passion, your practical tips, and your insights on executive director, executive comp, the little touch of director comp for trends in 2024 and beyond. For Women Get on Board, we will be donating to our charity partner, which is Dress for Success Toronto chapter, for your time today. We want to thank Southleigh Group for being our sponsor for today's virtual Women Get on Board speaker series. And as Amanda said, we've got a long-standing, strong partnership and continuing. So really appreciate your time and your commitment to both of you. Just on a quick note, our next Women Get on Board speaker series is on August 22nd. It is on advisory boards in 2024, the state of the market, and it's sponsored by Advisory Board Center. So I hope you can join us. Following the session, you'll receive a link to that event. You'll also have a survey. We'd love to get your feedback on the session today and any future topics. And you will receive a recording in the next few days. And if there's additional thought leadership that Alex and Amanda would like to share, we'll make sure it goes out. So to your board journey, may you continue to be empowered. Thank you. Stay cool and happy summer.
Thank you.
Thank you, everyone.